because these can be multiple streams of income for us. You can decide you're going to do the wheel strategy, which I'll tell you what that is in a minute. The wheel strategy is one part of your portfolio. You may do covered calls, cash secure puts. You may do shorting as a part of your portfolio. You may do the vertical spreads. So all these things are different ways for you to be utilizing your training as a trader to make multiple streams of income from the stock market. All righty. We don't have to only trade the one thing. We can, I mean, one thing as far as one vehicle, but we can trade multiple selling strategies and make money doing multiple things. That's what I'm saying. Okay. Cash secure puts. They are used when you think the price of a stock is going up. You're going to collect your premiums when you enter, just like we do with credit spreads. The broker is going to block the amount of your strike times 100, like times 100 shares of your buying power. For example, if you wanted to do SoFi and you want to do a 6 strike of SoFi on a secured or a selling a put, then the broker is going to block $600 of your buying power while the trade is, that should be an is, not an if, while the trade is on. Okay. They're blocking $600 because that's 6, your strike was 6 times the $100 of 100 shares. All right, this is selling a put. So you're in the puts area. We're going to do some examples in on demand when this is all over. I'm going to give us some examples so we can all see what's going on, but I want to hit the highlights of the strategies, the different things. Okay. So here we go. You can win cash secure puts in 2 ways. You keep the premium if the price doesn't come down to your strike. So if you got a cash secure put, let's say for SoFi yesterday, it closed above $6. If you had a 6 strike on a put yesterday on SoFi and it did not close below your $6, you just $6, then you were going to get whatever premium you took it at the beginning, you get to keep it. It's going to expire worthless, just like our other trades we've done in credit, credit spreads. If the price does go below your strike, though, at expiration, then you're going to get 100 shares of the stock at the price you chose. So let's say SoFi had closed at $5.85, right? That's below your $6 strike. Then you're going to be given, or you're going to be put, they're going to put 100 shares, which is where this whole puts come from. They're basically going to put 100 shares of this stock into your account at $6, because you said, when you said you were selling a put, you were saying, I'm willing to buy these shares at $6 if the price goes below, right? So you end up, they're going to put the 100 shares into your account at $6 per share, right? You're not going to get it for the $5.85. You're getting it for the strike you chose, and you keep the premium. So I'd like to say that cash secure puts is like a no lose. It's like a no lose. Unlike when we do verticals. When we do verticals, if you get breached, you lose the money, right? You don't get anything in return if you get breached in a vertical. But if you get breached in a cash secure put, then you get shares of the stock. So you don't end up, you either get premiums or you get premiums and the shares, right? So I consider it a no lose, kind of a no lose strategy. The only way it could really go bad is if you put in a $6 strike and SoFi drops down to $3, then you've got stocks you paid $6 for and they're only worth $3, but then they're yours to keep. Then it says, then you can use the shares to sell covered calls. All righty. Once you put the stocks, and you can always close these trades at any time. So you don't have to stay in it until the stocks are gifted to you. You can close it anytime before expiration. The shares are not put into your account until after expiration. If you decide you don't want the shares, you just want to close the trade out, you can close it out for money. Okay, you have to basically just pay back whatever the premium is worth at that strike. You have to buy it back, just like we do with our verticals. Alrighty, there's a lot of similarities between these. Remember, you're a seller here, so we're picking in the bid column. And when you want you're selling to open, STO, sell to open, and you're doing a buy to close. You buy it back if you want to close it, and you pay whatever it's worth at the time. So I talked about if you are put the shares, then your option you could use is to do covered calls. Well, covered calls can be used when you have 100 shares or multiples of 100 shares of anything. Some of you have 100 shares of stuff in your account already. You can be selling covered calls against them. Or if you have a long call. So let's say you've bought a leap, or you've bought time. Let's say you had a long call. You bought a SoFi call for January 23rd, which a lot of us, January 2023, have a lot of us have those. Some people might have got rid of theirs. I still have mine. So if you have a call on whatever, you don't have to be SoFi. I'm just using that as an example. You can sell a covered call against your options contract, your call options contract, right? Or if you have 100 shares of something, you can sell against it there. Basically selling a call against it, and you're going to collect a premium when you enter the trade. Just like you do when we do verticals, when you enter the trade, you are collecting a premium. Okay? To win, you win, the price stays below your sell strike. So if you do a covered call, let's say you have SoFi and you have a $6 and some change cost basis, and you sell a covered call at $8, then as long as the price stays below $8, you win the trade and keep your premiums. If price goes above $8, if you have 100 shares of it and price goes above $8, that was a strike you picked, then that means your option is going to be assigned. I'm thinking assigned, expired. It's going to be assigned, which means you're going to know the other word. What's the other word? Not assigned. You're basically going to have them called away, but there's a word that goes with it. If the price is above $8 and that was your strike, then your shares are going to be called away and they're going to be given to whosoever. I mean, they go into the world of shares. They go to whoever else was on the opposite side of your trade. All right. That means you would then collect $8 per share for something that you had for $6. Right? You can also do it the opposite way. Let's say you have it for $10 and you want to do an 8 strike, which means you're, taking the risk of saying, I'm willing to get rid of these or lose these for $8, but I paid $10 for them. So that's where you have to be mindful there, right? You can close these again, just like the other strategy. You can close them at any time. If the trade, if your covered call strike is going to get breached, or you want to keep your shares, don't want to lose them, or you decide I'm fine with taking the profits that I got, maybe you got a 70% profit and you're ready to just close it out early, then you can do that. This is what we did in the course that's called Leaps and Covered Calls. We talked about how do we marry these two things. You're buying leaps on something that you think is going to rise over the longer term, and you sell covered calls against that leap while you wait for the leap to grow. That was our plan with SoFi. It didn't work out quite like that in this case, but that is how you use that. Okay, you do leaps and covered calls. I think in the future, I probably would do more shares, covered calls on more shares than I would on leaps. But I've done this all year long, and it's been, steady money. I won't call it lucrative. It's been steady. It's been consistent money. So I'll call it that. But this is the wheel strategy here. Basically, you go from cash secure puts to covered calls and then around the wheel. So you start with selling cash secure puts. If your strike, if price comes down below your strike, then you get assigned the 100 shares in your account. Once you have the 100 shares, then you sell a covered call against those shares. If the price goes, if you got it for, let's say you did $6 on SoFi and you got them put in your account for $6, and you can do right away, literally right the next day or whatever, you can do a covered call for $6.50. Say, okay, I'm fine with the $6.50 strike. That's where you're going to get more premiums. And you said, I'm willing to let them go for $6.50 or $7. You put that strike in. If they get called away, then if you get assigned, you basically cast away the shares for more money than you paid for them. So it's like buying low and selling high. And then you sell another put against it, and you keep going and you continue to work the wheel.